Yeah, good morning, everybody. We're on 9:01. Well, the number's still ticking up, so I'll give it a minute or two and then we'll begin. Okay. Um, so thank you all for joining, diligently joining 9 a.m. on a Friday morning, in what must be a busy time for all of you. I was thinking about this presentation, and it struck me that, as South Africans, we're quite used to referring to the period of the budget as budget week, right? But in many ways, this feels like, I don't know, budget quarter or budget year, right? I mean, if you had to pick the big economic issue for 2025, it would probably be the extensive, detailed, drawn-out budget process that we've had, and the extent to which we're in sort of unknown territory. What I am going to try and do, though, is give you what I would call a very structured standard overview of the medium-term expenditure framework, which is essentially where the budget lives. So if we just keep in mind, and I'll refer to this a lot, the budget process works in clutches of years. So it'll run over a 3-year period, and what sits in the projections beyond what I would call budget 2025 through to 2 to 3 successive years is the medium-term expenditure framework, the MTF. And that becomes a really critical uh, sort of direction of change, or setting out of policy priorities, or projections for where the deficit would go, where spending is going to go by government. So it's a really important sort of way to think about fiscal policy in terms of multiples of years. What am I going to try and do? I'll try and do, I mean, as I said, the sort of standard expenditure, where are we spending, what are we spending on, the deficits, the debt figures, and then of course around revenue, the big issue being the VAT increase. But as I'll say and show to you, that actually the real criminal, if you want to think of taxes as crimes against the citizenry, lies not in VAT. It lies elsewhere, and I'll talk a little bit about that. But what I am also going to do as a second layer is to try and pivot the discussion slightly towards a more thematic understanding around fiscal policy, around the public sector wage bill, around the type of spending, whether we should be spending on what I call consumption expenditure or investment expenditure. And then, of course, as per usual, when I end, I'll look out for the questions and we can take them as they come through. All right, so this seems like a standard way to begin the presentation. There's only one slide here, and it's economic projections. But actually, it's fundamentally important. Before I show you the actual slide, and why it's fundamentally important, and I really want listeners to lock onto this, is that the every public sector indicator, target, the deficit, debt, revenue, when we measure buoyancy and so on, is often measured as a percentage of GDP, right? So debt to GDP is debt over GDP, right? So if you think about that, a fast-growing economy, a higher GDP, will lower your debt to GDP ratios, right? The denominator goes up. So it's fundamentally important, A, that you have a fast and high growing economy, and therefore high levels of GDP, because that helps you cope with paying debt, right? And again, with apologies for being too simplistic, it's the same thing as a household, right? If you have more income coming in, you can sustain more debt levels. If your GDP is high, you can sustain more debt levels. The trick and the art then of getting growth to be much higher than it currently is falls sometimes out of fiscal policy, but a lot of it actually is a large part of what we do with growth falls within the ambit of fiscal policy. However, what is also important is when you present your budget to us, which is what we've seen obviously with the budget 2025, is that you record your assumptions around economic growth, your assumptions on how big that GDP level, how big that denominator is going to be. So the diagram on the left shows you the forecast for growth rates for 2025 and I think you've seen this before in previous webinars that I've done. I just look at the different macro models. So whether it's an Investec or World Bank or BER or an IMF macro model, their projections are shown there, ranging from 1.3% for SARB right through to 2.2 for BER. The average forecast for growth, and I'll come back to the Treasury figure, is 1.75 for 2025. Now, of course, I know what you're all thinking, given what happened yesterday in Washington. Does this still hold? We can always raise that and talk about that later at the end in the Q&A, not the focus here. What is important, right, is my second bullet. So Treasury in budget 2024, so last year, assumed 2025 growth of 1.7, but this year it's increased to 1.9%. Now, that may be a function of more positivity and better numbers coming in sort of last quarter that informed the macro model and the update, but I think it's super interesting that we have a higher denominator. That means that if we miss the 1.9%, so in other words, as an extreme, and I don't think it'll happen, but let's say as an extreme growth ends up being 1%, right? All the debt to GDP, deficit to GDP targets will be out of kilter, assuming the numerator doesn't change, assuming debt stays the same, deficits stay the same. So it's fundamentally important that we understand this intricate relationship between debt in the fiscal space, between debt, deficits, and so on, and GDP. And as I argue there, right, missing a 1.9% target, right, and assuming no changes in or massive improvements in revenue collection and no revenue overruns and so on, does impact on all the targets that are set out. There is, though, and I just don't want to detract from it, there is the broader challenge of that right-hand bar. That far right bar is what the average, what is called UMI, upper middle income country, which is what South Africa is classified as an upper middle income country, is their growth rate. That's the average growth rate in a country that has the characteristics very similar to South Africa. They are growing at 2 times the rate that we are. So South Africa's growth rate at, let's call it 2%, right? Whereas the average middle income country is growing at 4%. That's the broader growth malaise, the longer run, if you like, growth challenge we face, which is an inability to get ourselves out of this long run growth trap. Now, we're not here to talk about long run growth challenges. That's for another topic for another day. But fiscal policy's role can be, should be, partially, right? It's not the only instrument to what we call, its role can be to what we call crowd in private sector investment. It can act as a stimulus to economic growth. And one of the questions has to be, have we seen the right type of spending from the fiscus to encourage economic growth? Okay. So with that as a background, let's look at some of the headline numbers. So what I try to do is not just present the current MTF framework. So here's my, hopefully you can see my cursor, but here's my point about the medium-term expenditure framework. So in other words, what you're seeing is the current budget projections for 2025, 2026, the revised estimate from last year. This is our budget 2025, I like to call it, right? And then you see the outer years represent the medium expenditure framework. So in other words, what is projected by Treasury to be, in this case, the budget deficit. Okay, so just keep that in mind, because these numbers get updated as you get revised estimates, of course, as you get real revenue figures, you get actual expenditure figures, and so on. Interest rates may move, so interest costs may change, and so on. So all of that gets regularly revised, and so that's why a 2 to 3 or 3 to 4 year projection is always useful for all economic actors. What is really important to see, though, is the bottom graph, right? So the bottom graph is really instructive for me because the budget from last year, the blue line, was the deficit to GDP ratio we were given in the previous fiscal framework or in the previous MTF or estimates of expenditure. We saw a budget deficit of 4.5% projected, right, for 2024, 2025. And then, as you can see here, right, actually falling, so these are negative, so falling to 3% by the outer year, 27, 28. What has happened, though, is really important to remember, right, and I don't think the media have picked up on it, is that we've missed those targets. So on the back of, call it growth, call it new spending priorities, no what I call super commodity cycle run that saved us on the revenue side, lower growth, no last minute sort of revenue spikes, has meant that we've actually now on a fundamentally different deficit trajectory. So what we see now is that our deficit target, so the revised estimate now that's coming through is a deficit to GDP ratio of not 4.5%, but 5%. And as you can see, the red line represents our new deficit to GDP pathway for the MTF. It's a higher deficit to GDP ratio, right? It's not massive. It's not a doubling, right? But it is instructive that despite Treasury's best efforts, I think the persistent spending pressures that have come through from cabinet, right, have meant that we are essentially on a worse deficit to GDP trajectory than was promised in the budget of 2024. I think one of the things so what I'm hoping to do next year is basically give you the same graph, right, for 2026. And let's hope that the red line that you see for budget 2025 would look exactly the same for budget 2026. In other words, there's no outer movement in terms of even higher deficit to GDP ratios. Why this is really important is for market credibility, is to ensure that your fiscal policy is predictable, that you stick to your targets, that you don't enhance deficits unnecessarily. And I think despite Treasury's best efforts, we haven't been able to remain on the current deficit to GDP ratio trajectory that was promised in 2024. The good news, though, and I think this is again, just put it out there. I'm a big fan of the Treasury team. I think they're incredibly smart and think very carefully about fiscal policy. I think all the, if you like, the thinking I have here, or all these suggestions and ideas, they would completely agree with. I think it's a lot about the political economy or the budget process, which we can talk about later. So as a reflection of this, let's call it strong focus of the Treasury team, we actually run a primary balance. So just a reminder, the primary balance is the difference between total expenditure less revenue, excluding interest expenditure, right? So in other words, when we take away what we're spending to pay off our debt in the form of interest costs, we are left with something called a primary deficit or primary balance, right? So what we see here is that we are still projected to run a primary surplus. So the idea that has been lost is not true. And I think it's important that despite the, as you can see from the bottom graph, despite the primary surplus falling, so in other words, in the budget 2024, you see the red bars, we were given these growing primary surpluses. They are still growing, blue bars, but at a much slower rate and below the 2024 figures. So effectively, part of that increased expenditure I'll talk about later, the 58 billion and other things, has led to a shrinking primary surplus. But it is reflective of a continuous attempt by Treasury to rein in spending where they can. If you just a sub point, which is a little bit of a detail point, is that the last year, what happened in the 2024 budget, if you recall, was this big long discussion about GFECRA, right? The golden foreign exchange account. And that then was used, the surplus from that was used to what I call bail in the deficit and then give us the surplus. So we only got the primary surplus, a little bit of a technical point, through the GFECRA account. There is a GFECRA item, I think it's 25 billion that you'll see in the later tables, but it's not necessary to run a primary surplus, right? So in other words, it's not dressed up. Let me just put it bluntly. The primary surplus is not dressed up as look at this great achievement when in fact it's a GFECRA bail-in. That's not the case at all. Um, so what they do, if even if I didn't show you the previous diagram with the deficit figures, you would look at this bottom graph, and I think I would argue, if any of you are working in this space, I would strongly suggest you do this, is go back to last year. And so when we get to 2026, we'll do the same. I'll look at last year and say, well, okay, what did you promise me last year and where do we sit? You can look at this red and blue bars and say, aha, you're still giving me a surplus, but you seem to giving me less of a surplus. And what may be going on is the key sort of driver of this budget, I think. So what are we looking at in terms of expenditure? In terms of rank, so 2.6 trillion rand is what we're spending in terms of total expenditure. So if you ever sort of want a size and shape of South Africa's government and its role, just think of trillions and just remember 2.5, right? It's an easy way to think about it. So it's 2.5 trillion rand is being allocated to various items ranging from education to health to social development and so on. You can see the list on the top diagram, right? A couple of things are important. Firstly, education, what is called learning and culture, is the largest item. So we're spending about 20% of our budget on education. We can have an entire different webinar about returns to spending, right? So we're spending a lot. Are we getting the returns we want? That's a separate discussion and a very detailed one. So this is not about the quality of spending, it's just the pure quantity. But notice that the second largest item looms, right? And it looms in a negative sense because it is debt servicing costs. So in other words, in order to sustain that higher deficit, we've actually seen debt costs edge up. So last year, again, not in the minister's speech, not in the actual MTF. You have to go back and say, well, how much did we spend for every rand on interest charges? It was 21.5 cents, but this year it's 22 cents. Again, think of yourself as a household, right? Managing a budget. Your budget is 2.5 trillion. That would be wonderful. And you suddenly figure out, but hang on, as I move from last year to this year, I'm spending 0.5% more on servicing debt. Not a good space to be in. The other thing that is worrying is the growth in spending items. And you do see that the second largest growth the second largest growth rate belongs to interest charges or debt service costs. So economic development, right? A little bit of an amorphous category grows the fastest, but notice that our debt service costs, for example, are growing at a rate faster than we're spending on education and health. Another thing to lock onto, or even social development, right? So the extent to which we are financing current expenditure needs at a faster rate than we are able to grow spending on, let's say, non-interest charges such as education, health, peace and security is a really important reflection of the extent to which what I would call the degrees of freedom. We're not, so let me be very, very clear. We're not in sort of crisis territory. We're not in sort of fiscal collapse territory, not at all. It's a nuanced point about just be very wary that the guardrails are narrowing, so to speak. We have to be very, very careful about the amount of extra debt that we can take on and the extent to which debt service costs are creeping up. So what, as the minister said it quite publicly, it was a 58 billion problem, right? So what arguably drove, although it requires a little bit more detailed analysis, which I don't do here, to look at the drivers of the deficit, right? Because it's a little bit more complex than simply the 58 billion, but it's a big part of the difficulty that the National Treasury team faced in trying to stick to that deficit trajectory. So here, just I know there's a lot of numbers here, so if I could just take you through the current uh, budget period, which is the 2025-2026 period. So I call it budget 2025 because it's just so much easier, right? If you look at the bottom of that top table, you see the 58 billion. So this is the 58 billion that the minister spoke about, which is there are a few sort of, let's say, sort of reductions to that 58 billion or the total spending that comes out for it. That gives him a net spending of 58 billion. But the middle section, which is here in the rectangle, reflects all the spending priorities, right? That gave him the 58 billion. So let me just go through some of them. The first, right, is the public sector wage bill was cost a total of 23 billion over the full period. So one thing I should have mentioned, he speaks about 58 billion, but notice that the full cost over the 3-year period is not 58 billion, right? It's this 142 billion. So the key thing to remember, again, think in 3-year periods is, okay, so you've said it's 142 billion. When I come back next year and I look at this table here, I hope nothing's changed. And here's the first thing that worries me tremendously about this, which was not mentioned in any speech. Media didn't pick up on it. It hasn't been noted. It's stuck in this table 3.4 in the estimates of expenditure, is the COVID-19 social relief of distress grant. So what do you notice, right? You'll notice that it's only in this table for 1 year. So it's 35 billion for year one, and then there's nothing. So the commitment is for a single year. What that means is that if the politics of the SRD continue in the way that they are, we are going to have to find an additional 70 billion, which is to fund the outer years and then beyond that, right? So that's my one big concern, if you like, is that we've kicked the can down the road in terms of the social relief of distress grant. Is it important? Yes, it is. If you look at the bottom graph, you'll see that it accounts for 34% of all new spending. A little bit of good news for those of you who have links to healthcare workers and even those in police and security, what I call frontline services, is that there has been an additional allocation to resolve some of the blockages, I think, in health, education, and security services and so on. So that's the second largest allocation at 22%. And that continues as well for a full 3-year period. So the idea that you actually trying to provide some sort of relief to public sector services, including in home affairs and so on, is probably an important part of what Treasury wanted to do. The one that I spoke about last year, and I provided the warning last year, if you go back to my presentation, I said last year that the public sector wage agreement in budget 2024 was set at 4.5%. That was the increase. Of course, that was never going to happen. And I said that wasn't going to happen. And there you have now the 7.5%, which is the additional carry through from the 4.5% that was never agreed to by unions. They signed off on the, I think it was 7.5%. And so that costs the fiscus now an additional 23 billion over 3 years. The one bit of good news is that it's fully costed. So it goes away. They don't need to come back next year, and we don't need to talk about the public sector wage bill and whether there's pressure coming from there. What is my overall concern? Well, my overall concern is that just about all these new allocations, except for the top line, which is infrastructure projects, right? At about 14, 15 billion a year, gives us about 46 billion over the 3-year period. Except for that, and it only constitute 14% of the total new spending, the rest of our spending is on what I would call social spending or operational spending. There is no investment spending by the fiscus, right? Treasury did try the capital spending that we're after through allocating to infrastructure projects, because one of the key instruments that government has to direct economic growth and development is to crowd in private sector spending. The only way you crowd in private sector spending is not by social grants, it's not by salaries on public sector workers, it's by spending on infrastructure, right? It's by building and improving roads, rails, ports, all that sort of good stuff. Even outsourcing housing, right? In terms of infrastructure, that kickstarts the economy in a major way. That's what's called, that's what we refer to as fiscal policy crowding in economic growth. That hasn't happened, right? So essentially, we are continuing on a trajectory where our fiscal policy and our spending priorities tend to be um, biased towards consumption expenditure. Now, one of the things that was hotly debated in cabinet and also in the public discourse, of course, was around the social relief of distress grants, right? And so one thing that is clear is the strong focus in this budget 2025 to provide some sort of catch up in real terms for social grants. So you see on the top left there all the percentage increases for all the social grants that are currently in place, and you see the values, the current values that are now going to be in place for the 2025-2026 period. One of the things, though, that I've debated publicly and it has been raised in policy circles is the idea that the social relief of distress grant is a really important part of our let's call it our attempt to reduce poverty and create employment in the society. And the debates we've had, and I put sort of a very academic piece from sort of journal article we've produced on the left here, ask the question, what is the impact of the SRD on employment? So you may have read stuff, the odd sort of example, I use the SRD to start a business and so on. In essence, what these econometric estimates show on the bottom left, I'm not going to give the full explanation, is that 1 month after the receipt of the grant, there is a positive effect on employment and search behavior, searching for employment and starting a business. But 2 to 3 months after that, the effect declines, and by month 3, the effect is zero. In simple terms, the SRD cannot, and based on our current evidence, does not act as an incentive to search for jobs, to find a job, or in fact, even to start a business. So if you're trying to use the SRD, the COVID grant, to resolve employment or growth related issues, it's the wrong instrument. So if government, though, and this is a really important point, if government, though, is trying to solve or use the grant to reduce poverty, let's say, right? That's the broad, right? We want to reduce poverty. Then it's not clear that keeping the SRD is or will have a bigger poverty impact relative to, and look at these grants here, increasing the value, for example, of the child support grant or their old age pension. And that's the switch, that's the policy switch that government hasn't been able to make. And so currently the work we are doing is trying to resolve that empirically and figure out which grant increase will have the biggest poverty impact. But we seem to be stuck on, well, we're going to keep the COVID grant because it exists. And that seems like the worst possible solution or policy solution to have. That the only reason you will extend the COVID grant is because we currently have it in place and there's sort of NGO pressure on it. I know that seems far removed from the world that many of you live in, but this is a 70 billion rand problem, right, on the outer 2 MTF years. And I think that for me makes it a very critical fiscal policy issue that we have to get correct. But I referred to this crowding in of fiscal policy, and the number that probably also keeps me awake is what's happened to government capex or investment spending by government. I've given you can see the graphic, right? It's basically the equivalent of a downhill, right? None of which will be in the two oceans, unfortunately, this weekend. But be that as it may, the 11.7, 12, let's call it 12% capital spending as a percentage of total government expenditure is sort of what we used to have in the 94 2000s period. And now we've seen that reduced by 4 percentage points, and we have to cope with a government that effectively starves the private sector of capital spending. It's not a government that is designed in its current form, with its current fiscal framework, with its current fiscal envelope. It's not designed to encourage private sector growth. It's abysmally low, the capex that we are allocating to the economy. And if you keep in mind the incredible rate at which we do see leakages from that existing capex, government's role is very, very minimal. Treasury is aware of this. Let's be very clear. All right, Treasury is very, very aware, hence the infrastructure allocation that they put in attempting to shift the dial a little bit. There are innovative mechanisms in the existing budget, such as an infrastructure fund and so on, where Treasury, outside almost of the budget process and their budget envelope, has tried to set up structures where there's sort of a 50-50 participation between the private sector and government to encourage capital spending. Almost every developing country, and in particular in emerging markets, we'll see that later, use government as an instrument for economic growth. I think we've fallen off the wagon there. I think we've lost we're on a trajectory where social spending dominates far more than it should relative to capital spending. And if that is not convincing enough, what I give you here, again, as a broader thematic discussion about fiscal policy in this budget 2025, is ask the question, let's look at public spending as a percentage of GDP, public investment. So that would be your ports, roads, rail, and so on, and compare that to social spending. That's the sort of, it includes education, health, and so on. And what you notice, right, is that South Africa, right, and these are all different countries, South Africa is the highest, one of the highest spenders on social assistance, as well as broader social spending in the world. So on social assistance, which will be grants, right, we spend far more than countries that look similar to us, like in Argentina, spend 2.1% compared to ours, which is over 5, 6, 7, 8%, right? In addition, and if you look at the countries there, even a country like Brazil and like Mexico and Latin America that led the charge in terms of social assistance, in terms of conditional cash transfers and so on, spend far less than we do on social assistance. So we've become, I mean, to use the old phrase, we've sort of become an ATM machine, right? In terms of government's government's war on poverty, or government's growth vision, if you like, through the fiscus, is essentially far too biased towards social spending. Not to say grants are bad, but the balance, in my view, is out of kilter. Where should we be? Well, if you want to go to the top of the class, of course, go to that CHN at the top there, right? That's China. What does that tell you? So I always say to people, China will see a poor village, right? In the west of the country, because the west of the country is far less developed than the east, and go to that poor village and will not hand out grants. They won't be over here. What they will do is provide the environment for that village to actually function self-sustainably. They'll provide roads, they'll provide infrastructure, electricity, housing, supply side measures to grow firms, and so on, build factories. So government becomes an instrument for public investment, not social spending. And in many ways, time and time again, it's been proven over economic history that if you allocate much more to public investment as a government rather than social spending, and that's true within the budget that we currently see, and I think the continuation of this trajectory is becoming much, much clearer, that we haven't deviated. If you look at the previous graph, we have not deviated in the last sort of 5, 6, 7 years, let's call it, of budgets. We have not moved away from a budget that is far heavily focused on social spending relative to investment spending. As I've said, what happens in this kind of environment is that you do not create the conditions for economic growth. And in fact, if anything, you crowd out public investment in a high debt environment. One sort of final big thematic point is that within this division of social spending versus investment spending, we also, and this is globally tested, and the graph on the left does that, we also spend or allocate far too much of the fiscus revenue on the public sector, right? So simply put, we have a bloated public sector. The public sector wage bill is far too high. And the way we do this here is that if you look at our wage bill as a percentage of GDP, low is good. Sorry, this is for public sector workers, right? Wage bill as a percentage of public sector. Oh, the public sector wage bill as a percentage of GDP in the country. Higher is not good. Lower is better. So we're way up here, right? And you'll see you've got a bunch of Latin American countries. You've even got Greece. You've even got Denmark. We can talk about that later. So some countries do have, we're not the only ones that have, but we are very high up with Brazil in terms of having a very high public sector wage bill. However, what's really important, right, is that if we are above the 45-degree line, sorry, this shouldn't say 400, I don't know why it says, but the 45-degree line, right? That means even when we're comparing our wage bill to government expenditure, right, over here, right, we are spending more, right, of our public expenditure on the public sector wage bill than it is due relative to its share in GDP. If that makes sense, right? So in other words, we are overspending as a government on the public sector wage bill. It's not only high, but it's higher than it even should be relative to its share in GDP. It's a little bit of a technical point, but it's a very important reflection of how we've got it wrong on both counts, right? So not only are we too high, but we're above our share of GDP. For me, that reflects the really tough discussions around, well, are we getting a return to spending? We're spending so much on the public sector. Are we seeing returns? It'll be fine if we're Denmark, right? That's the point about Denmark, really, because the services you get are high quality. You get high quality outcomes in the schooling system. You get high quality outcomes in public services, in home affairs, right? All sorts of things. This is an efficient government. Then you don't mind paying public servants a lot. If you don't get the returns, all you've got is a bloated bureaucracy that's highly inefficient, and in the fiscal policy sense, is a poor allocation of fiscal resources. Okay, so with that sort of, if you like, broad remit on fiscal policy, the expenditure priorities, and where the 58 billion has gone, and why I think broadly, thematically, we need to think very hard about social versus investment spending. One of the key outcomes, right, of spending more than you earn, of course, is that you have to start telling the markets and you have to start telling the world about your debt to GDP ratios. Now, I gave you the picture of the deficit to GDP. Remember, that's an annual figure where we just look at how much did we spend relative to how much did we earn, and we look at the deficit, we express it as a share of GDP. But of course, as we are raising debt in markets, this is not an annual figure. It's a multi-year figure because governments borrow for over a 10-year period, right? So think of it as the bond on your house, right? That's your full stock of debt that becomes due at different points in time over the next 10, 20 years. Governments go into bond markets and they purchase debt in order to finance our spending. The key here, though, is the top left graph, which is consistent with what's happened. So this is not surprising, but it's just important to note, consistent with the deficit to GDP ratio in the last budget. So you recall, if you go back, if any of you have my PowerPoint from last year, you would have seen the equivalent of this budget 2024 debt to GDP ratio. And I was actually quite positive. If you go and look at my notes and say, okay, well, this shows that we're going to move away from the overspending years under Jacob Zuma, and Treasury, I think I said the adults are back in charge at Church Square, and Treasury has shown that we're on this very clear deficit, debt to GDP ratio, debt to GDP reduction path, right? From 74% down to 67, still high, but the change was positive. My notes and my sort of assessment last year was uh, positive, cautiously optimistic. Now I'm a little bit more worried because our debt to GDP ratios have become elevated across every single time period. Of course it has, right? Because that wedge, if you like to think of it, the difference between those two, that shaded area, is our additional spending. And it would be great if it was ports and rails and roads and all sorts of investment expenditure, and that 8% capex went up to 15, then I'd say happy days, right? We're using debt to do investment spending, but we're not, right? We're using debt to finance effectively the public sector wage bill, the SRD, critical services, and so on, right? Uh, One argument you could make is, hang on, we are a middle income country, things are messy, we have these priorities that we have to spend on. Of course, we understand that. So, well, let's compare ourselves to other middle income countries. Well, that's what this is, a treasury graph, it's on mine, right? And that's why I say Treasury is very clear about the concerns they have over the debt to GDP ratio, and that they tell us in the estimates of expenditure that South Africa's debt service costs as a percentage of revenue, right, are much, much higher. That's the red line, much, much higher than the average middle income country, even if you take the range, which is the shaded portion, and you can see the graph. So let's call it 8%. Let's make it high. 8% is the debt service cost as a percentage of revenue for the average middle income country. For South Africa, it's double that, right? So South Africa is spending twice as much as the average middle income country on servicing our debt. And so that then for me becomes and you can see Treasury's attempt to show in this 2025 period is, you can see the nature of this graph, that we are not going to try and breach any limits beyond what we currently have. And so for me, possibly the most interesting thing, if I could be a little bit facetious, about this year's budget is what next year's looks like, right? I want to look at budget 2026 and see if this debt to GDP ratio looks the same. And what I would love to be able to show you next year is that the red line, or orange line on top here, and the budget 2026 number look exactly the same, right? Or frankly, unlikely, but looks similar to the yellow line. Very, very important to keep an eye out for that. So, how worried should we all be? Well, most macro models, especially looking at emerging markets, show that once you breach sort of 80% debt to GDP ratios, it's not the case. So, please don't worry about Japan and the US running, debt to GDP ratios of over 100%. I joke with people. What I say is the bank will come to me when my debt to GDP ratio is 79 or 80%, right? But they're not going to come to Bill Gates when his debt to GDP ratio is 80%, right? So larger economies, richer economies can sustain much higher debt to GDP ratios. That's not the case for South Africa. I was worried as I went through the budget documentation and looked at the elevated debt levels that something may be happening with respect to ownership structure, but essentially ownership structure of bonds, which are the holders of South Africa's debt effectively, hasn't really changed. So we've seen the foreign flight, if you like, from 2018 already, right? So the sort of from 36% in 2013 from foreign investors accounting for 36% of government bonds in terms of ownership in 2013, that's gone to 24, but that's an old story. That's already occurred. So they haven't reacted any further in the last couple of years. So essentially the broad structure where domestic pension funds, for example, moderated their demand. Other institutions, local institutions have picked up demand for government bonds. That sort of broad structure remains the same. We haven't seen any sort of major alterations. The one thing just to keep in mind is that there is the concentration risk, right? So banks, the domestic banking system holds a lot of South African debt. So, and even though we have very, very deep financial markets, one does need to keep in mind that a healthy, diversified ownership portfolio of domestic bondholders is important for general financial stability. The other thing you do want to keep an eye on is the term structure of debt. So, governments, again, in order to finance the debt, will sort of play in both short and long-term markets. They'll have different types of products, inflation-linked bonds, treasury, the fixed rate treasury bills, foreign loans, and so on. The broad term structure of debt hasn't really changed. There's been a slight increase in the weighted term to maturity of fixed rate bonds and treasury bills, and then inflation linked bonds, it's been the reverse, where we've reduced our holdings. Nothing really to speak about. There is, and I'll show it in the next slide, a little bit of a discussion about, okay, what about your mix of short term to long term loans? So you play in the market so that you can get cheaper short-term debt, and pull away from long-term markets, long-term debt. That hasn't really changed dramatically. And more importantly, I don't see any clear sort of, let's call it, foreign exchange denominated debt threat, right? Which is the green bar in this bottom here. In other words, the extent to which, so in other African economies where 70-80% of all your debt is denominated in dollars, you are immediately under the cosh in terms of foreign exchange movements. I don't see that strengthening dollar, for example. I don't see that as a threat in South Africa. So just on the term structure of debt, the yield curve, so Treasury does point out, right, that the yield curve has shifted downwards, which for them indicates confidence across all bond maturities, right? So that's the top left graph in South Africa's debt management. May be true, but the long run trajectory is not positive. I think I show that a little bit later. So yes, there's an understanding that as long as the Treasury team stays as it is and they keep on saying what they do, we're fine, but we do worry about the absolute levels of debt. There has, though, in the bottom left diagram been a sort of, and then the macro guys are constantly at this, been a discussion about the maturity profile of South Africa's debt. So if you look at the yellow bars, the idea compared to the blue bars for each year there, the idea is that South Africa's average maturity of its debt, right, is much, much higher. So 12 odd years, coming down to about 10 years, but much higher than the average G20 emerging market, which is a nice comparator for us. Treasury is aware of this, and so the idea that you should actually move your debt towards a shorter maturity profile is within its sights, but I think they're also worried, right? And I think they're right, that you shouldn't flood the market with short-term bonds. There are all sorts of concerns around macro stability, interest rates movements, and then suddenly you could actually end up with a cash crunch on the government side if you too heavily focused on short-term debt. Okay, so back to the broader sort of expenditure profile, what we tend to find, and sorry, I must keep an eye on the time. I don't want to keep you too long. What we also try and focus on beyond the sort of beyond debt and deficits is the public sector borrowing requirement. So why that's important is I just want to again take you through this. So you get the main budget balance. This is the one that we all fixate on, that 352 or 353 over there, right? That's the deficit, the value of the deficit, right? That's total expenditure minus revenue, boom, 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 and we get a debt. But remember, government has to pay back loans. That's the redemptions. And government also has debt that sits and it needs to be repaid in state-owned enterprises, something we know a lot about, right? That total is called the public sector borrowing requirement. So you take the budget deficit and you add to that deficit, if you like, loan redemptions, any bailouts or any sort of state-owned enterprises that you need to sort out in terms of debt management. And then in our particular case, we've got this relief from GFECRA, which did the work for us. What do we see? We do see a sharp rise, right, in the public sector borrowing requirement in this MTF, right, in this 2025-2026 budget. So in other words, From last year, we were told 415, this year 581. It is expected to moderate, right? But note that the public sector borrowing requirement is not going anywhere. It's not substantially going to change over this MTF period. And a quick scan of this would show you that the loan redemptions are doing a lot of the work. Put simply, what's putting pressure on the public sector borrowing requirement is that we have to repay loans, right? The term structure of debt. As the debt becomes due, you've got to start paying these back, and that then feeds into our servicing costs. So essentially, the impact of loan redemptions is critical in significantly increasing the public sector borrowing requirements. So the Treasury then starts playing in sort of multi-year worlds. So we'll try and change the term structure of debt so that we push some of this debt out to future years, right? I think it's very ironic, as I put here, that the Eskom debt relief alone, that 64 billion, right, would have avoided the need for a VAT hike. So for me, that's also so symptomatic of where like the cost of state capture is. What is our debt relief for Eskom? 64 billion. What did we want in additional spending? 58 billion, right? So instructive in terms of the cost of state capture. There's no real change in state-owned enterprises. They're still basket cases, right? So almost all state-owned enterprises, right? If you read the medium-term expenditure framework, it would be as if a citizen has written it, even though it's written by National Treasury. They talk about, you can see the quote I have there, right? Persistent weaknesses in these companies. They're thinking about closures, mergers. They will withdraw financial support. There's poor quality management. Many of these companies are near financial collapse. They are poor service providers, and they're thinking there, of course, of Eskom and so on. As of budget day 2025, even the second one, the quarterly financial reports of SAA, Transnet, Denel, Eskom had not been submitted to National Treasury. Just think about that, right? Think about being a JSE listed company and doing this, right? So you've got dysfunctional state-owned enterprises. Treasury is very, very well aware of it. And I think the way around the politics of selling off state assets is to actually engage very actively in public-private partnerships. Sorry, I'm trying to speed up a little bit because we're already an hour in and there's quite a bit to get through. Now, one really important phrase that you may have heard in undergraduate, or I'm sure in graduate studies as well, is this idea of government dissaving, right? It's a really important concept because it asks, again, the following question. Think of yourself as a household, right? Do I have enough revenue just to keep the lights on, as we say, right? So if we look at this table on the top, the current revenue as government gets in on a monthly basis through SARS, and what are my current payments? And you can see what current payments refers to. It means compensation of employees, right? So you're paying people's wages, you're paying for goods and services, and then interest payments that are monthly due, and then transfers and subsidies to provinces. So I'm excluding all investment expenditure. I'm excluding all the sort of long run stuff. I just need to know, am I earning enough revenue, right, to pay for wages, to pay for basic operational costs to keep government functioning? And the answer is no. The answer is no, because current payments are actually higher than current revenue. That's the idea. So if you think back to it, if I have more, if I'm earning a lot more revenue, I have 10 Rand of revenue and I'm only spending 8 Rand on salaries, on lights and water and so on, I have a 2 Rand saving. 2 Rand saving that I can then use to build ports and, do good things, right? Grow my garden, right? Increase the value of my house. I'm using that metaphor. But if I don't have that 2 Rand, I'm not saving. I'm just saving. That's the idea. So we ask the question, what's the size of government saving? Well, okay, it's large. It's 196, close to 200 billion. and it is not likely to reduce until the absolute outer year of the MTF. Okay. Now, again, we're looking for signals. Where I would be worried is if I see every single trajectory of, let's call it the negative numbers, debts, deficits, saving, public sector borrowing requirements, all going up or not changing, or staying stable, then I'd be very, very worried. But for me, what this suggests is a very tight fiscal space. We can talk about in Q&A why Treasury finds itself in this position. Um, but it is clear that Treasury is committing to reducing all the bads in our fiscal space, the deficits, the debts, and here in this case, public sector saving or government saving. And you can see the scale of the reduction in the bottom graph. So if we're starting to worry, right? So let's just go back to this idea of, so you've got debts, you've got deficits, you've got the idea that government's borrowing and borrowing, let's say arguably at an increasing rate. We ask the question, which needs a little bit of background. Is there a challenge around what we call fiscal dominance, right? And fiscal dominance is the case where government borrowing is so dominant, right, in an economy that it strangles and pushes aside every other form of lending in the banking system. Let's make it the bank or in financial markets, right? And so financial markets become completely dysfunctional, right? That fiscal dominance has all sorts of outcomes, right? It burdens the financial sector with sort of only being forced to deal with one client, namely government, which has political power. It forces out private sector providers. It changes the element of price discovery and capital allocation for other needs in the economy, right? Through the financial markets, right? Private firms and so on. But it also forces, what I have to go into now, also forces monetary policy in a defensive position. So monetary policy is then worried about the printing press, it's worried about inflation, it has to defend the currency, especially in terms of foreign loans. And so you have this horrible cycle of rising interest rates amidst a defensive banking sector, and government then dominates the space and puts pressure, loses potentially central bank independence, turns to the printing press, and then you've got a proper crisis. We are not there yet, right? We are nowhere near that. So in case we start getting confused about where we are in the rank ordering of crisis, this is Sri Lanka. That's why you got a revolution in Sri Lanka and you got the president being ousted. It was fiscal dominance, right? They tried sort of printing press, hyperinflation for a bit, and it didn't work, clearly. Pakistan is there. That's why this great macroeconomist from Princeton, Atif Mian, speaks about this as an autoimmune disease. He's a Pakistani by birth, and he's particularly worried, right? So where fiscal dominance is a serious issue. Here's South Africa. If you're looking for us, we're right at the bottom, stuck in the middle here, right? So we have lots of neighbors. We are nowhere near. We are still below that sort of debt service to revenue ratio, which is what we use as a guide for a measure of fiscal dominance. So we are way off that position, and I think we have a very, very strong financial sector, independent sort of business lobby groups, independent Reserve Bank that's going to prevent us moving in that direction. But just keep in mind this idea of making sure that government debt doesn't become so large that it forces out or skews the allocation of capital in other markets. But overall, we are facing a debt challenge in terms of making sure that at the current 71%, right, debt to GDP ratio, we don't move further up. I think you've seen this graph before in other presentations. The broad idea is that markets are worried. Our debt to GDP ratios are higher than they should be. National Treasury is critical. It is the last institution standing, right, in terms of avoiding a debt crisis, right, which we saw, where we saw a massive confidence decline with the firing of the late Pravin Gordhan and Tsibisi Jonas. But I think we're far away from that, right? They're huge problems, contingent liabilities, low growth, rising tax GDP ratios, and so on. Um, uh, but we're far away from the full-blown crisis. I think markets are a bit more circumspect about how carefully we can manage our way out of this um, uh, short-term fiscal challenge we have. Okay, so let's turn to the tax proposals. You would have seen um, their whole range of new taxes, right? Specifically, the most obvious one is the VAT increase of 0.5%. It's for this financial year and the next, and you'll see it here in the table, right? But notice what often is forgotten is how much of it is going to be, let's call it, put back into citizens' hands is through the additional zero rating. So in other words, the new products, and I'll turn to those that are coming in for zero rating, actually puts back over 2 billion into citizens' hands. Um, excuse me, collectively, the new tax proposal raised 28 billion. In other words, short of the new spending proposals. That's why we're sitting with that 30 billion hole, right? The 58 less 28. So we end up with a set of tax proposals that has resulted in a lot of evidence and a lot of discussion around the new increase, which is VAT. I think too little emphasis on what's happened to personal income taxes, right? Bracket creep sits front and center to my mind, right? As probably because it's so democratic, right? Because it's spread amongst every single taxpayer, it's very hard to see the total negative impact. In my view, it's the bigger evil of the two taxes. Let me just through talk through that. If you look at the new tax proposals, right, the amount that we're trying to raise, that 28 billion, ask the question, what share of that 28 billion is being raised by different taxes? And it's very clear that the highest burden of the adjustment is actually borne out by bracket creep. So no inflationary adjustment to tax brackets means that even though the cost of living's gone up by 5%, your wages go up by 5%, boop, you go into a higher tax bracket, you pay more taxes, but actually your real income stayed the same. So you're poorer, effectively, right? Because you're paying more tax. And so that's sort of a very common, let's be very clear, it's a very common tactic used, and it's very open, right? I mean, if you look, this is a Treasury document. They say no inflationary adjustment to tax brackets. So that's going to give us more money, 18 billion, right? So they're very open about it, and it's a very common measure used by most governments around the world. What is uncommon is the extent to which this is dominating the funding requirements, right? So close to 2/3 of the new funding requirements from the new taxes actually come from bracket creep rather than VAT. VAT comes in at second largest, right? Close to 50%, but it's essentially the no inflationary adjustment to tax brackets, which puts more individuals into these higher inflation adjusted, with their higher inflation adjusted wages into these higher brackets, that accounts for the majority of the raised revenue from National Treasury. So for me, the VAT increase, yes, important, but the real revenue driver here in the first year is personal income tax. However, when we look over the full MTF period, then the inflationary adjustments do less of the job. They account for 50% over the full period of the extra revenue we need, and the VAT rise takes over for each MTF period at accounting for more. So the thing I worry about is what I've called, and if you read signals, I've referred to that in one of my signals. I probably buried it somewhere. But I refer to something called the Laffer curve, right? The Laffer curve is the relationship between tax rates and income and effort, if you like. And essentially, what happens is the incentives to work decline, and so the revenue raised by each rise in tax rates should increase revenue, which is what the Laffer curve will show. So if you think of it as an upside down parabola, as taxes go up, revenue should go up. But at some point, taxes are so high that people stop working, that the incentives to work decline. People withdraw their labor, maybe rely on their savings, because if I'm spending all this time to give 70% of my income, for example, to work, maybe I should stop working and rely on my savings if I'm 55 years old, right? That sort of is a real example of what's happened in many countries. The revenue from higher taxes actually starts declining, hence the upside down parabola. That's the Laffer curve. And we've seen in the last tax increase, so this is a really important point. Go back to the signals, and we're happy to share it if you want it. In the last tax increase that we had that moved the top marginal rate, revenue actually went down. When we increased taxes at that top rate, the revenue from that top rate actually declined. We'd reached the turning point in the Laffer curve. And so I do worry about this. I do worry that bracket creep can only be pushed so far when to such an extent that at some point the aggregate revenue you may end up getting, I don't think we're quite there yet, but in certain tax brackets, the aggregate revenue may actually go down, right? As individuals reach a point at which it's cheaper or better to stop working rather than pay so much income into taxes. So what we do see as a broad remit around tax revenue is that it is dominated by personal income tax and corporate income tax, right? So personal income tax grew at about 13% over the first 11 months of the previous budget period, and that's a very sharp increase driven by improved revenue collection um, and the two-part retirement system. So what we do see is the sharper increase, higher than the projection from SARS. We saw revenue surpassing the initial estimate of 5 billion. We went up to about 11.6 billion. And in fact, in yesterday's business day, I see that SARS came in with a higher than expected. I think it was 18 billion more from revenue collection. So let's just stand down on that, or stand a little bit on that 18 billion. The question that can be asked is, but can't you use that 18 billion to finance the 58 billion plug, right? What Treasury is going to do, though, is use that 18 billion to push back on debt costs, which I think is the correct, instead of giving more room for funding and taking away the VAT increase, they will probably put it into reduced debt costs. There's also something called the global minimum tax, right? And that was in last year's budget. So this is just more of a budget update. And that is a OECD global international tax that's um, coming into operation. That will force companies that are large domestic and foreign multinationals who are operating in South Africa to pay a minimum tax of 15%, and then of course beyond. Note the sharp decline in mining and mineral royalties. I think that's a large function of the dysfunctional or the lack of operations in the mining industry and in DMRE around mining licenses and the uncertain environment around regulatory environment around BEE and so on. SARCU revenues have always been a feature of government discussions. It's a historical fact where we redistribute as part of being a monetary union with these countries, but that's not an insignificant amount, and it's come up before with Tito Mboweni and others. Okay, so as I said, most of our tax comes from personal income tax and company tax. Specifically, 46% of our total revenue comes from personal income tax, close to 20% from company tax. How high is this? Well, personal income tax is high, right? So the bottom graph, again, from Treasury, right? So Treasury, again, is alerting us to the fact that, don't think I can go back, Mr. Cabinet, to the markets or to our citizenry with higher tax increases, because they're pointing out that as an upper middle income country, all those gray dots around South Africa are high income countries. Those are the top personal income tax rates in those countries, and South Africa is way above many other developing countries, right? On both counts, both in terms of the top personal tax rate, so in excess of 40%. I think there's only one country that's just at 40%, but there's a whole bunch that are way below us, as you can see, and that's over here. But note our personal income tax as a share of GDP is much, much higher than other countries, particularly the middle income countries. So as a share of GDP, we rank 13th, right, in the sample of 123 countries when we're looking at corporate income tax. So what we tend to find is a corporate income. So even on the corporate income tax rate, we've got companies that are arguably far too high taxed relative to other middle income countries. So the extent to which we've played the tax card, as it were, and we need to either the denominator needs to go up, we need to look at GDP costs, or as I come to later, look at reduce spending or better spending to encourage growth, becomes a critical sort of set of decision making for National Treasury. So I just again want to alert us to the fact that, there's this lazy thinking around VAT is everywhere and always regressive. Well, it's wrong, right? So the data from the World Bank and the Davis Tax Commission has consistently shown that VAT is mildly progressive, right? So in fact, what you find is that as a share of income, if you look at the VAT incidence, right, when you include zero-rated goods, VAT is in fact mildly progressive. Now, that's based on the old zero-rated goods. I suspect that when we widen this basket to include the new zero-rated goods, right, which is the current proposal, and you see the full list at the bottom, I suspect that if you look at those and you look at those that extended list, what is likely to happen, particularly given the nature of these products, is that the progressivity of VAT would actually go up. So if there's anything I could ask you gently to think about more carefully, right? And again, I did a signals piece on this as well, that was covered by Sunday Times, that caused all the brouhaha around the VAT increase and so on. In that article, I refer to the fact that VAT is not regressive, right? If you look at the distribution of the tax across deciles, you will find that post-tax, post-VAT disposable income of the poor as a share of total income actually is makes them better off relative to richer households. So again, and I think that's what Treasury were after, right? Treasury were after that as a VAT option as opposed to other taxes. So what else do we find? Well, this is what the Davis Tax Commission does. So this is what I meant about, we're not going to get into the politics of the budgeting, but I mean, I just wish that opposition parties, other members in the GNU had actually read the literature or at least consulted people, right? This is not my diagram on the left. This is the Davis Tax Commission. What did they say? They said, when we asked, what is the impact, the macroeconomic impact of a 3 percentage point increase in VAT? But let's compare that to revenue equivalent increases in PIT and CIT adjustment. So let me get the same revenue from a PIT and CIT adjustment. What is the impact on revenue, on GDP and welfare? Well, guess what? Firstly, you get the most revenue from VAT. You get the lowest negative impact on GDP, 0.65 versus a much larger impact on personal income tax, on GDP from personal income tax and corporate income tax, and you get the smallest socioeconomic impact. So effectively, Treasury knows this, right? Economists know this. You know this data. What is your option? You either take on more debt, which is really bad, right? Or you push back against the politicians. That hasn't happened, right? So you push back on the public sector wage bill and you refuse to increase the SRD, right? So we can talk about why that didn't happen. But now that's a fait accompli on the 58 billion. So what are you forced to do? Well, let's look at our tax options. Because I'm not going back to, increase my debt. That I'm definitely not doing. Right? That has ramifications I can't control. Investor sentiment, global market reaction, and so on. But a VAT increase, manageable, which is the which is the most pliable of them in terms of negative economic effects? Well, it has to be the VAT adjustment. So if you can just give me 1 second, I am okay. So for me, that we're sort of near the close of it, right? That sort of gives you hopefully an overview. Um, Um, that 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 sort of gives you an overview of what I think are the major expenditure items, where our revenue options lie, the debt position we are in. Now, of course, normally every year that would just be the end of it, right? But now we have this crazy situation of a government of national unity, and so the parliamentary budget process actually does matter. Um, What is so, as I was going through this note, which I prepared last week, things had changed, right? So I'm not going to go through the current state, but we can take questions on it and we can talk through it and on the politics of it and the GNU and the DA's sort of court case and so on. But just go through the process, which is what's happened now, is that first that government had to approve a fiscal framework, right? Um, the fiscal framework is the first process which says what are your revenue, what are your revenue projections, what are your debt and deficit management policies, what are your assumptions around growth. That's the broad fiscal framework. That then goes, if that is passed, which is the process that was just done now with the DA not voting for it and so on. It also covers the VAT increase, by the way. Um, if that wasn't passed, there was Section 29 of the PFMA, which allowed government to spend up to 45% of the previous budget's allocation. So we didn't have the challenge always, we never had the challenge of what the US always has of a sort of shutdown in government and so on, right? So we could have spent up to 45% anyway. So it kept this process moving in terms of paying salaries and so on. Um, the the fiscal framework being passed means, in essence, that we've gone through the first hurdle, right? Which I think means that the three bills that follow it, which is the appropriations bill, division of revenue, and the tax bills. Now, funding allocation to government departments, that's the appropriation bill. The division of revenue, as it says, right? The shares of national revenue, both national and local, and then the tax bills, right? Are the ones that follow the fiscal framework. So my understanding and my reading of it currently would be that, and it depends on the agreement that Action SA and the partners that signed and voted for the fiscal framework have with the ANC, is that these three bills should now pass through fairly easily. However, if Action SA decides that, oops, we should have voted against VAT and we didn't realize that VAT is not negotiable now, which is exactly the case, right? That once the minister announced it, VAT is law. So VAT will become law, and the only way you can overturn it is in the next cycle next year. And if they do overturn it, I'm not sure how you're going to reclaim all the VAT that's already been paid. It just seems silly, right? So, um, but I think we in this, at least aside from all the drama about the GNU, we seem to be on a road towards adoption of all these three bills, given that the fiscal framework has been passed. It may get bumpier. It's possible that Action SA and others walk away from the fiscal framework and refuse to then adopt these various bills. That could happen because they only need a 50% majority, but at the moment it's razor thin, in which case things can get really, really complicated. Okay, so let me end off with a couple of slides on thinking about our longer term fiscal position, because I think it's really important that we keep in mind that there are two things that we always want to look at when we talk about the budget. One is the budget 2025. So what were the estimates of expenditure? What did we spend on? What's new, the COVID grant, and the tax and the VAT increase, all that sort of stuff. But you also want to keep in mind the multi-year framework. That's what I said at the beginning. So let's then ask the question, standing a little bit back, further back, now that you understand all these terms about fiscal dominance and so on, and ask the question, what does our long-term fiscal position look like? So there's some great work done by Roy Haverman and colleagues at Stellenbosch, I think it is, and at Wits University. One of the key identities in fiscal policy is what are called R minus G. R minus G refers to, firstly, R is the interest on debt, right? And G is growth rates. So if R minus G is negative, minus G, so in other words, G is higher, growth is higher than the interest on debt. If it's negative, it's actually a good thing, right? It means that the interest on debt, right, is at a rate that is lower. It's a simple identity, but it works really, really well. It comes from Oliver Blanchard, the IMF chief economist. It means that the interest on debt is at a rate that is lower than our growth rates. What that means is that we almost get a fiscal free lunch. It means that growth rates, because they're so high and higher than our interest on debt, will pay for the debt by itself through the revenue channel. You have this, imagine so just think in simple terms, 10% growth rates. We'd have massive revenues, right? And so the debt to GDP ratio would be much lower. The debt servicing costs, right, as a share of GDP would be much lower, and so on. So R minus G being less than zero, which is what we had in the blue line for South Africa up until the Jacob Zuma mess, right? We were actually pretty much on a very strong fiscal footing, right? But look what happens from 2017 onwards. From 2017 onwards, the relationship turns positive. So now interest on debt is higher than growth. We are essentially I spoke about a long run growth trap. We are essentially in the fiscal equivalent of a long run growth trap, right? So we, in essence, are paying the fiscal penalty, right, of not generating high enough growth, because it's the growth story that gives you the revenue push to sustain your debt levels, right? The market knows this, right? So the market knows that your growth rates are too low. You're going to struggle to pay debt, right? You are becoming poorer, right? And so we all know this, right? As households, right? So the less income you have, banks start getting a little bit antsy in terms of how much they want to loan you, the terms of those loans, what they want to loan for, and they become far more active in managing your debt. That's where we are. The bigger challenge for us also is that it gives us fewer degrees of freedom in terms of foreign investor confidence. Now, this fiscal trap that we're in is reinforced by expenditure. These are three lovely graphs. That's not lovely in terms of the results, but beautifully succinct, right? In terms of our fiscal challenges. Expenditure to GDP goes up, but at the same time as we're spending more, hence debt to GDP going up, right? It's because our revenue to GDP ratios have flatlined. So essentially, we are a government that's spending too much, right, relative to GDP in an environment of declining or low levels of GDP that have kept revenue flat. And many commentators have noted that, and I've shown it to you here, the spending even that we have, that expenditure to GDP is too largely concentrated in consumption expenditure and too little in investment expenditure. As I've said, that leaves us with a very, very long walk to what I call fiscal freedom for South Africa. So with that, I'm hoping that you got a little bit more than a simple overview of the budget, that what you saw was what I believe to be year one of what I think is should be a 2-year process to keep a watchful eye on what's going to happen to the deficit to GDP ratio, to the debt to GDP, to public sector borrowing requirements, to government to saving. Those numbers have to be watched very, very carefully. And what I'm hoping to do next year, if I still have a brain on me and I'm still living, is to show you the same presentation and say, guys, remember last year? So now let's look at budget 2026. And did we get what we were promised in terms of staying on those targets? I think for me, that's absolutely critical. But what's thrown us out of kilter, in my view, is consumption expenditure that probably shouldn't have happened. The compelling case for the SRD hasn't been made yet. We're spending 35 billion on it. And the public sector wage bill was last year's problem that came back to us. And we're spending on a public sector wage bill that is already one of the highest in the world relative to GDP and relative to total expenditure compared to other countries. Growth needs to do the job, right? And it's not, right? It's simply put, growth is not doing the job. Fiscal policy is partly to blame because we are spending far too much on social spending and not enough on investment expenditure. Efficiency of government spending is one key quick fix. And I think part of the positive discussions that have come from within the GNU is about that. Okay, if we're not going to spend less on the public sector wage bill, let's get our outcomes to improve, right? Let's reduce corruption, let's reduce wastage. But beyond that, even if there's zero wastage and corruption, are we getting learner outcomes that we expect from spending so much on education? Are we getting improved health outcomes? Are we getting improved services from municipalities based on the spending? Those, for me, are the kinds of micro details that will guide fiscal policy going forward. But as it stands, we now wait for the GNU process to unfold, and we also wait for the formalities of the budget to be closed off. Okay, well, let me stop there and take some questions. See this. Yeah, so again, the first question from Gareth is around the primary surplus. So the primary surplus is, yeah, so it wasn't a topic invented for the masses. It's actually just it's a macro identity just to show, can you, are you doing something positive when you take out debt? But I agree, you know, the, the idea that you can spend at the margin continuously without consequence is something that you can do once, but if you start doing it repeatedly, that's what I meant about next year. I think the markets will punish us. So I think the question is it fair to say that the ANC is trying to purchase voter support by sustaining the high social grant expenditure and the high public sector wage bill? I think to some extent the ANC or the government needs to keep in mind that you can't and you shouldn't use unsustainable spending as vote catching machines. I mean, that's just silly, right? That's unacceptable because that's not the role of fiscal policy. And I think National Treasury understands that, right? So I think is it a broad ANC position? I don't think that's true, but I think at the end of the day, it becomes very difficult on the back of continued NGO pressure, continued press and media coverage around the SRD, and in fact, the view from a general population that says, well, it's only 350 Rand. Why are we doing this? And in many ways, I think it's more about what you're trying to solve for, as I said, right? If you're trying to solve for poverty, well, maybe you should triple the value of the CSG and for 35 billion, maybe you'll get a bigger poverty effect. And I think that's something to keep in mind. So the next question. Yes, so I think political will is a serious challenge. And I think the extent to which uh, uh, next year becomes, I think we're very far away from, the IMF getting involved in a bailout. That's why I took you to the fiscal dominance kind of story. I think we're far away from that. I mean, I think there's much more discipline than people often give government credit for within Treasury and so on. They will push the envelope, but I think you can see the direction of changes there. So I think we're far away from irresponsible fiscal policy. I don't think we're there. I think, it's just a case of, okay, guys, but why did you give in to the spending pressures? Why did you not give us the 4.5% as a 7.5 last year? Now you've snuck it in and you've kept the SRD. This is not good. So next year, either you resolve this, and we hope that growth is not the only solution that you come with, right? So you save by growth or revenue spike, and I think that's where it becomes an important sort of political will point. Um, so the impact on the grant on um, yeah, so there's a lot of evidence on the impact of a grant, right? So does it disincentivize work? Does it disincentivize uh, um, employment outcomes? The evidence is not that strong for the other grants, right? All I was trying to solve for is that does the SRD activate employment search, which was a big claim amongst the adherents? And the answer is no, it doesn't, right? So it's not going to create employment for you. And I think that's really important. Um, yeah, so on the Trump tariffs, of course, I mean, it's very unclear at this stage what the impact on GDP is going to be. Some of the numbers we've seen from the very early models, global numbers from global macro models, I don't know the details of those models, show negative effects, of course, but actually smaller than you would think. But let's just hold on for that for a moment. But I think where I worry about the tariffs, of course, is on particular sectors like agriculture, where um, where we're not exempt and where large tariff increases passed on as price increases to US consumers will see them turn away from, citrus fruits and so on, and maybe buy cheaper Mexican alternatives. I'm not sure, right? So the substitution effects may be large enough that we actually struggle. So I think that's where I do worry about the sectoral effects. Um, so the expropriation without compensation, I don't think the echoes of Zimbabwe are really, I think that's not true. I think that's way off from what the Act itself says. Remember, the Act is about essentially is about public land, um, and you have to still go through an entire process of um, trying to compensate the seller in an extreme case. If that doesn't occur after courts and after backs and forth, then there can be EWC. You can tighten the law. Is anybody going to come for your house? No, that's just nonsense. I don't think anything that's happening. If I could say one political point, I think AfriForum is just awful and wrong in terms of what they're saying. Um, yeah, so I think this is a great point about. I know the National Treasury team well. I work with them regularly. I've trained some of them, and they do understand the economics. They understand everything I've said. They would agree with everything, but it is about the political world. So I think that's a really important point around, well, at some point, there has to be a pullback from cabinet to say, well, look, actually, we're not going to spend on the SRD, or we are going to take the unions on, or we're going to ask for much harder returns in terms of better spending rather than simply always giving in to the highest bidder. Um, so there is David Avis has got a question around, which is a good one around sort of, yeah, but isn't there also a push through for the economy in terms of higher wages? So that's true. So what you get is a consumption driven growth recovery, right? So you put more money in people's pockets and so on, and that then drives growth, but it's not sustainable. It's not sustainable because it's debt financed. Because it's debt financed, you'd much better, in terms of getting the mix right, you've got to switch away from current spending towards investment spending. The switch. So not no spending on wages or no increases, but in fact making sure that investment expenditure is much higher than it currently is. Okay, we can share last year's slides for sure. Um, yes, so I think we have to relook at our growth. So Charlie Simpson, we have to look at our growth outlook for this year for sure because of Trump's tariffs and how that's going to come through. I mean, I think AGOA is probably gone. I mean, effectively, it has to be gone if you take these Trump tariffs as given. There's also the round two of these discussions because the argument is that Trump will look at these tariffs as an opening gambit and say, okay, well, come and negotiate with me and let's see where we can go. Remember that I think a large proportion of our minerals are also exempt, so there's that as well. Um, Sorry, I'm just going through the questions. So how many years away are we from fiscal dominance? I think what I was trying to say is that we're not. So if you look at our debt to GDP ratios, we should not be anywhere near fiscal dominance, right? Just because the trajectory is to see a decline in debt to GDP ratios. That's my point. It's about, okay, well, every year, I think if we came over the next 2 years and we saw this upward creep of that debt to GDP profile, then you would worry, right? But not at the moment. Um, Yes, I agree about local and provincial governments. A key challenge in terms of implementation. Um, so there's always the question about my view on the rand. Dave van der Berg, I have no idea. And anybody who tells you they're lying, right? I mean, in any given day, the rand will move 10% up and down in different directions. So one thing I will say is keep an eye on the dollar. I think worry less about the rand and look at the dollar because I think the dollar is where all the action is. So the dollar was supposed to strengthen with with these tariffs, but in fact the dollar weakened, right, because of growth concerns. So um, the likelihood of outright US sanctions against South Africa, Johan, I don't think that's likely. Remember, we have critical minerals, right? We have critical minerals that the US can find nowhere else in the world or in very few places around the world. So the platinum being one of them. So I think just keep that in mind. We have bargaining power more than we think. Uh, so various questions about, yes, Eskom debt relief and government's willingness. I think you have seen government sort of at the nth hour pull back on certain things and shift course. I do worry that the notion that spending has to be reined in hasn't landed yet amidst low growth. I think the next year is absolutely critical, and certainly I'll be doing that through the advisory council and other spaces in presentations like this to say, well, look, um, you've probably reached the limit of what you can do in terms of additional spending. So please don't come back next year and make the 58 billion. Remember, it's over 3 years, so it's already baked in for 3 years. But please don't make that any higher than it already is. Um, okay, I think most of these have been. Yeah, so the outlook for US interest rates, I mean, that's an interesting one. I think if you listen to one of the Fed governors, I think yesterday, she spoke about the fact that the weak growth outlook worries her as much as prices. So as soon as the Fed starts talking about prices, then you know that there's no chance of interest rate reductions, at least for the next quarter, nothing else. So it's a wait and see, I think. But certainly that sort of 3, 4 cuts in 2025 projections, those have to be revised. So I think that has all sorts of implications for us as well. Okay. So municipal funding, I think, is a whole other topic on its own, but I think municipalities are collapsing, certain municipalities certainly. And so the extent to which Treasury can rein them in and manage them is absolutely critical for local economic development. Okay, I think the sort of 30 odd questions I've tried to deal with. I'm hoping that you all found this super useful. I think the Signia team will share versions of this as the requests come in, but I'm very happy via the Signia team to take any questions and further comments. All right. And I think we're now at 10:40, so I think you've had a good start to the day around budgets, but I look forward to speaking to you all again at the next webinar. Thank you very much.